Starting in February of this year, the stock market ran into a lot of volatility. Volatility is a fancy word that means big swings in the ups and downs of the value of a market during one trading day. We tend to like volatility when the market is moving up, but not so much when the market swings are on the downside. Unfortunately, the big swings in the first quarter of 2018 contained a lot of downside volatility. Here's a look at how our allocations performed in Q1. Each of our 7 allocations had negative returns. Note how they followed the pattern that we have seen in the past. That is, the larger the percentage of stocks in the allocation, the larger the loss in the quarter. The 25-75 allocation, which is only 25% invested in the market, lost 1.1%, while the 95-5 allocation, which has 95% in the market, lost the most. Nonetheless, with the loss of 1.8%, it was much lower than what you were hearing on the nightly news, swings of 500 to 800 points during a day. When you get caught up in the fear of the talking heads, you need to remember 2 important points. First, not all of your money is in the stock market. Some of it is in short-term fixed income, which has no correlation to what is happening in the stock market. Second, your portfolio is not invested only in the U.S. market. The nightly news talks about the Dow Jones Industrial Average and the S&P 500. Those are only 2 indexes which represent a very small portion of only the U.S. stock companies. Your portfolios are globally diversified, which means you own stocks in 45 different countries. Investing is a journey. It's a journey that covers many years. One quarter in the long scheme of time really is not meaningful. That doesn't mean it can't be scary. Wall Street likes to scare people. Wall Street likes volatility because it scares people into making bad decisions, like bailing out of the market. Wall Street makes money when you sell and makes more money when you buy back in. Emotions are an investor's worst enemy. Here is a look at how real investors have fared over longer periods of time. These are actual unaudited returns from each of the 7 allocations. The difference between this table and the previous table is that the time frame for each allocation is different. Those who started to invest in 2009 did better than those who started to invest in 2011 or in 2013. The markets hit a low point in March 2009. Historically, over longer periods of time, the main difference we expect to see from one account to another will be based on allocations more than any other reason. I know my message doesn't seem to change, but that is because I have been through the ups and downs of the market for so many times. I understand the pattern. I am always available to talk about your individual portfolio, and we should be sitting down no less than once a year. Circumstances change, and when they do, we should talk. Enjoy the warmer weather because spring is here. And meanwhile, here is the disclaimer.